Okay, we'll go ahead and get started. My name is Lisa Rodriguez. I'm the Director of Retail National Accounts here at NewView Trust. Today's webinar is going to be about market trends and success strategies for commercial real estate in 2020 and beyond. I must confess first that we are not attorneys, nor CPAs, nor financial advisors, so NewView is a non-fiduciary, and all information provided today are for educational purposes only. And just to give a little bit of background about NewView Trust, we do custody IRAs for clients that want choice. We've been in business for 17 years. We custody over 1.4 billion in client assets, and we have about 47 trained and qualified administrators here in Longwood, Florida. We like to pride ourselves on being simple, making our processes simple, being available for our clients, and also being responsive to your needs. So much so that every Monday in our staff meeting, we talk about how many calls have been answered, and we strive for at least 99% on that. So we have been doing well the last couple of weeks, and so again, it is a priority for us to be available for you. And today I'd like to welcome Dr. Joshua Harris from Skanska USA Commercial Development, a leading developer of high-rise office, multifamily, and mixed-use projects in urban cores nationwide. He serves as an advisor for the senior leadership team and acts as the head of strategy and research, coordinating all business planning, market analysis, and research initiatives. He's also a Knight, so go Knights. Without further ado, I'm going to go ahead and introduce Josh Harris, if you'll go ahead and take that over for us.
All right. Well, it is great to be on here. Obviously, for some of you, again, I'm not sure who's on the call, but I obviously lived in Orlando, and I know Longwood is right there in the metropolitan area from really the early 2000s until 2017, when I moved up to New York, originally to work for New York University. I was a professor there for a few years before with University of Central Florida, and now I've rejoined the industry side with Skanska on the commercial development side. So, today's an interesting opportunity to get to speak with everybody. My role, in kind of a nutshell, is essentially the kind of head of research and strategy, which really is basically investment strategy for our commercial development unit in the U.S. And we are a Sweden-based company, but we have operations in Europe and the U.S. So it's kind of an interesting time, because obviously when things get interesting, and that's maybe the most polite way to say it, suddenly someone in my role is basically a real estate economist type market expert. Well, suddenly, I get a lot more phone calls, and everybody up and down from the organization are suddenly very interested in, well, what's going to happen, what's going on. And, I'm going to give you a lot of my own thought processes. I'm going to tell you a bit about what we're looking at, how we are viewing the world, and attempt to kind of just tell you some of the things we think about, what we know, don't know. But I will tell you right now that I don't have any perfect crystal ball. Nobody in our company, and anybody who gets on TV or gets on a webinar and tells you they know exactly what's going to happen is probably fooling themselves, if not trying to fool you. So, I think that. I know, obviously, if you're a client of NewView, it means you are somewhere responsible to want to manage your own funds, and you are making investment decisions. Well, that's where we are doing the same thing. And it's not easy, and it's not easy in these times. So just everything I say, just know that I offer no better crystal ball than anybody else. But with all that said, our company, just like many people, we still have to make decisions in this environment. So that is kind of giving you just where we're coming from, and what a little bit what the day in the life looks like. So I'm trying to click, and Grace, I don't know if you've given me control to switch over. So I'll do that. So. But I'm going to start off by kind of just showing kind of examples of some of our past projects, give you a little bit of the way we think. We like to say that we are not a typical developer. We are part of Skanska, which is a large company. Now, obviously, those of you who are in the Southeast, it's not a market we do our development work in, but it's certainly in Central Florida, actually all of Florida, very big market for construction, as is most of the Southeast. Ultimate I-4 we're the lead contractor and P3 investor on it. Done a lot of work for UCF, and all, if you know it's always in all of our brochures. It's the Florida Polytechnic University, that very unique looking structure college. It's on Auburndale FI4. So if you're from Central Florida, you know, that's some of our construction work, but we're on the development side. So we're a little bit different. We've been in sort of 5 markets, and we've generally approached it from very interesting. And our story is a little bit interesting. I think it's extraordinarily apt for today's times, is that we actually started as a business unit in the US about 10 years ago. And the impetus for the broader organization starting it was the '08 crisis. They actually had management meetings. Ironically, they were in Orlando, right on the same day that Lehman Brothers filed bankruptcy back in 2008 in September. And they basically kind of scrapped their original agenda and said, well, how do we make money off this? How do we approach this situation? And the ultimate answer that came up wasn't immediate, was to start developing commercial real estate in the United States, figuring that this was an opportunity to get in. So that's a little bit the way we looked at it. And some of the first projects, actually, those of you who might know the Boston area, there's a thing called the Seaport District. Now, if you haven't been in Boston in a long time, I'll tell you that it's completely changed. And this is one of the assets that we built. We've already invested this. And we were kind of a pioneer. When we really launched into the Seaport District, there wasn't much going on there. It certainly wasn't known for Class A high-end office. Now it's kind of become one of the new hit places. So we kind of have a mindset of moving into sort of that transitional area that we think will be the next place. Because we are internally financed, we don't really have to answer to banks or investors type of thing. So if we want to go in and take a risk here and go speculative, which is what we did, we can do it. And it's a very unique way that we're able to approach it. So obviously these are the kind of things we look for. We've also did work kind of more towards the Back Bay of Boston. This is a multifamily, and believe it or not, we didn't actually go into multifamily first off. We started with office, and then the market shifted. And this is obviously before I joined Skanska, they said, you know what, there's a lot more opportunities in multifamily. So mid 2010s, or we call that last decade, we moved into multifamily, just an example. We still pretty much lead in office. This was the first LEED Platinum. One of the core tenets of Skanska is to build everything to the very highest specs of sustainability possible. So we built what was the first LEED Platinum building under the new version 4 certification. This was in Houston. And if anyone knows, there's a sort of an iconic building in Houston that's called the Bank of America Tower. Well, Bank of America was tired of their old space, and they relocated their whole regional headquarters to our new building, which also is now called the Bank of America Tower. And we have if you kind of, I know that, I'm not sure you can see the picture, people sitting on the stairs, but if you know Houston, it's connected to this really interesting walking district, to say the least, a tunnel system. We are at the kind of a 5-point connector. So we built a very interesting retail understory with all kinds of unique, mostly restaurants, kind of a very interesting approach. But this again, you know, we kind of took the edge and said, we're going to go ahead with this in a market, Houston, where not a lot of people are doing spec development, ended up working out pretty well. And obviously, I mean, look, there's no, you know, like I said, we face these kind of challenges, but I will tell you that, you know, when we look at markets, we say, well, what's a good location? What makes it work? And I think, you know, I mean, location as for anybody who's interested in commercial real estate, or really any real estate, houses, no different. You know, that old adage of location. I mean, it's corny on some level, but it's also true. And we wouldn't have had the success in any of these buildings if we didn't have good markets. I did notice something was like a raise hand. I will say there is a Q&A function down below. I will address Q&A kind of towards the end, but if you want to go ahead and type into the Q&A portion, I will turn to that as soon as we get to that section. So move on. Again, this is also back in the Back Bay. This was another one of the early residential properties we did. The Seaport was kind of interesting, and I think this is a major trend that had started really a long time ago, really was a big trend in the last decade, that quite honestly is a bit in question, although we'll get into whether we think these questions are worth having. But you know, the whole idea of having downtown high-rise apartments next to the office buildings, right? For a while there, we were all living in the suburbs for the high-end, called the high-end rentals, and then commuting in, and then high-end, you know, development really kicked up. So obviously, you know, what makes the Seaport a very unique area is that you can live there and work there. Now, it's not cheap to live in the Seaport of Boston or in any high-rise in Boston. It's a very expensive city. But increasingly, this was heavily demanded, very much the millennials trend. And, you know, as we saw people who were sort of delaying marriage and having kids and all these things later, there was a bigger and bigger market for apartments. I think one of the questions people are asking in this midst of COVID and other things, Is that demand for the urban living going on? It's got a question I'm going to address a little bit later, but I think it's, it's important to realize what a core element of both our strategy and really a lot of most urban development. Certainly those of you in Florida, I think about every Florida downtown has seen massive increases in the urban apartment environment, on a relative basis. So we'll see how that might or may not get affected. One of the last ones here, 2U is an office that we did in Seattle. Obviously, this was one of the largest projects. Now I can't, this picture's not great, but if you can kind of see this building in the center, we actually had to lift it. There's a cool YouTube video if you're going to idea of interesting construction. We had to lift it up 85 feet in the air, essentially on what are large concrete pylons, and sort of lift it above it. So, we're willing to try stuff. It ended up being pretty cool, but I can imagine there was probably a lot of hair pulling at the time to decide to go through with this. So this is just a kind of a simple, I think this is one of our simpler projects was in DC. We ended up, to give you an idea just sometimes how crazy the investment market for apartments has been, which has really been, the investor demand, like when we go to sell an apartment building is just amazing. We sold this building in 2019, essentially the day we completed it, with 0 occupancy, and there was a lot of institutional. All these are institutional investor purchased by pretty large firms. We were able to sell it literally 0 occupied. Now, of course, the management company was kicking in and taking, was going to take it over and start leasing right away. But just give you an idea now, and I think that's an open question, but whether multifamily in particular, especially the urban-based multifamily, whether does any trends shift there? I think it's an open question that people are starting to address. So. I am going to talk a bit about the state of the market. This is very to the moment as best I can. I'll tell you that from doing economic presentations, and I did in my kind of prior consulting and academic life, I did a lot of real estate economist talks for various companies and audiences. And typically you could I would call it a slide deck presentation or a thought process. It might last a couple months, maybe a quarter. Then you have to update the data, and then typically updating the bullet points. They change here and there. Maybe there was some news story that had to be addressed. But, I could say that maybe 80% of my presentation or what I was going to say would largely stay the same quarter to quarter. We're at a time where month by month, even week by week, I can't even say that. So, what I say today might be out of date tomorrow. That is literally how fast some of the other forecasting, like Moody's, we're subscribers to Moody's Analytics to get some of their economic forecasts and their real estate forecasts. They had to, I think in March and April, I don't know if they needed to do this, but they did this. They literally updated their forecast about 4 times. They normally do it about once a month, and really only a major update every quarter. So things are changing, as you guys probably know. And if you're monitoring your own portfolio, you might. My advice, if you got, I don't know if you can see my camera, I'm holding up my phone, but if you got one of these, you might want to just mute all those alerts and stuff like that. It's probably not going to make you. It's probably not going to make you a better investor. Excessive trading is never generally good. And frankly, if you I hope you didn't sell, but obviously. You couldn't have predicted this stuff. So I generally say that this data changes fast. So I put that as a big caveat to just say it. So I'll give you some ideas, some things we're looking at now. What's really interesting, and this is, there's some arguable debate. And unfortunately, if you watch the news, especially even like a CNBC, so much of politics and just sort of passions of the day is creeping into economic and dare say market analysis, which doesn't necessarily make it better. No question about it, COVID, and economic shutdowns that follow really are going to shut down the economy by design. Now, I know a lot of people in the Southeast and Florida on this call. I think this is very similar to what you see in a natural disaster. This is very similar to a hurricane, right? If you have except that it's nationwide and your evacuation zone is effectively the entire country. How much the storm, or dare say the pandemic, has actually hit us is still sort of being determined, and unfortunately it's not over. And if you watch the news, maybe it's resurging even in Florida. I don't really know. It's not my expertise, but we expect GDP to be massively down because things were shut down. But with all that said, there's actually a lot of evidence says we're already in the rebound or some form of a rebound at this very moment. We'll get, obviously the second quarter isn't ended. We've already started to see a turn back. We've seen varying different data points. Hiring may have been very positive in May, which really surprised a lot of people. It should be pretty highly positive in June, but it's not really. The thing about the hiring that you see these numbers, it's not really the same thing that it means, say, a year ago. right? If you shut the business down by government order because of pandemic, yes, you lose your job and you do lose your income. And obviously if you're getting the government support or whatever is going on, but it's not the same thing as the business literally deciding to go out of business and you don't have a job, which is like after '08. And we're all thinking, if you're thinking about trying to compare what's happening now to the '08 recession, my advice is don't. They're very different. So you definitely, need to understand that some of these job losses, when you see these massive numbers, 20 million, et cetera, they might be short-term. Now, some of them are permanent. We've seen some job losses that are definitely permanent, but we don't really know what it is. So there is a converse to that. When you start to see these like 5, 10 million up numbers, which we might see, I'm not making a prediction for what the June number is going to be, but it could be, if May was up 2.5 million, it could easily be 5, 10 million or something like that in June, which it's in the realm of possibility. They're not like real job creation in the sense that a business went outside, we need to hire these new people. No, they're just bringing people back to work. And we've seen in the construction side where projects were shut down, people went on furlough, but guess what? Almost everything is restarted. So those people are back. They're going to be counted as new jobs. We do see consumer health figures to show, and I think retail sales, and I've always been a big believer that retail sales tells a lot of the story. It's consumer confidence, it's also how much money consumers have. Down in March, down in April, like you would expect. I mean, obviously, some people buying more stuff, like literally toilet paper out of all random things. But May was a big surprise up, and I think June will continue. We've seen mall traffic be very high. We've seen driving, all the mobility measures. I mean, by all measures, consumers are much, much healthier than we might realize. But it still is, like to say, it's a very hazy picture. So I thought this was very, very interesting. And I would suspect if you're on a call like this, think about what maybe you did in the month of April. And we don't have May yet, but the savings rate shot up to 33%. There were literally trillions of dollars added to bank balances. Now, obviously, look, that's also the month that the government began sending those stimulus checks. Unemployment, they also got that $600 bonus. I think some of that paid in April, which meant for lower income people, right? I mean, at least in states like New York, it meant up to about $57,000 of equivalent income potential. People saved a lot, and also people probably stopped buying because they couldn't go anywhere. I mean, you couldn't travel, et cetera. So, that points to a healthier consumer. Obviously, unemployment, you can see that graph on the right, shot up. But again, it's just not really a comparable. I would argue it's not a comparable unemployment rate to say the unemployment rates which crested above 10, 11% in the '08 crisis. It's a different market. So I say consumer health is a hazy picture because there's weird evidences of strength in that regards. And I think it's one of the hardest things even as our company. I think this is why the stock market is somewhat doing what it's doing, is that you see one data point, and it says, oh my God, that's horrible. Then something else comes like, well, wait a minute, if that was so bad, why isn't this so bad? And I think there's a little bit of a discongruity in that picture. And we're just going to have to, unfortunately, I think we just have to kind of ride out and see what happens. Real estate markets, where I kind of spend my time, I will say we're kind of a slow reactor. Because obviously, I mean, like in our business, it's about leasing, it's about rents. There's no magic formula to what we do. We build buildings. We hope they're what tenants want to lease. At the end, we hope they sign enough leases at enough rents that institutional investors are willing to pay a good price to add to their portfolios, right? It's actually a very simple business, as complex as it might look at times. But so our health kind of rises and falls with the economy and markets. We know this is nothing new. This is the nature of the game. Anybody who has a real estate investment, you understand, right? If you have a tenant, if you're fully leased, it's a great day. If you have vacancies, it's a bad day. I mean, that's how it is. And we've not really seen a lot of impacts. Everyone thinks there'll be big impacts to rent. They haven't really hit. Not to say that they won't happen. And government support has definitely helped out our portfolios. But we've had a very strong performance in our own portfolio, which we don't have a lot really on our books. Not quite our business model, but I mean, multifamily rents have been paid close to 90%. We get the data from National Multi-Housing Council. Commercial rents out of NAREIT, mostly for office, industrial, have been paid close to 90%, which, I mean, still, there are some people who aren't paying. Retail and lodging has been terrible, but we know retail is largely shut down. And I think the issues with retail tenants is the most common one. But again, they're shut down. So, it's hard to pay rent. When they reopen, hopefully they can start paying, but I don't know if they can pay their back rent in all the circumstances, but they should be able to start paying rent once they reopen, or at least partially. So in terms of pricing, and I'm sure a lot of you, if you're thinking about investing in real estate, or you're going through this own consideration, I'm sure there's some of you on this call that are like, will there be huge discounts? And the honest answer is, I don't know. There's a disconnect in buyer and or pricing. By the way, Real Capital Analytics, where you see on these slides that are on the screen, RCA data is for generally $5 or $10 million I think, generally 5 million and above in the U.S. Actually, they say 2.5 here on one of these slides, but that, they're generally the 5 million and above category. So just give you an idea of what the kind of data that they're offering. We've seen disconnects in buyer pricing, selling deals. I mean, deals aren't coming together. People also can't get on airplanes. I'm not entirely sure what it means. We won't, it'll be a few more days before we know what the month of May was. So this is all mostly data through April, which is not far into it. But we are seeing some higher amount of, they call collapse deals. I mean, we have heard of, there's been some very public reports of large investors walking away from even large deposits. Blackstone, I'm not going to don't quote me on the number, but Blackstone walked away from a several multi-million-dollar deposit on a office building they were going to buy in San Francisco. That broke a lot of news in the commercial real estate media. So, but largely we haven't seen, in fact, the last price series, which only went through April, the May one's out this week, had prices rising. So, sellers will pull things off. So, I mean, I will tell you that the discounts in the commercial real estate market, there might be, I think there will be buying opportunities. I mean, it would be crazy if it doesn't, especially if you're interested in retail and think you have good locations. I mean, retail, by every data point that's out there is got its issues and besides it's the obvious common sense, but we'll see what happens. I mean, I think it's an open question. So, and by the way, I should say, if you do want to ask questions on this, I'm happy to sort of deepen into some speculation based on the question you're asked, but it's, I can only tell you what I know. And I think we're all watching this. I will tell you that I remember in 2008, there was so much money, and I was in Florida at the time, which was kind of an epicenter for this at that time. There was so much money going out to chase distressed real estate, but a lot, banks decided really not to do the foreclosures. They pretended and extended by government mandate or regulator mandate, I should say. If you see it, I guess what I'm trying to say is that if you think something is a deal, don't think that there won't be other people going after it. I mean, that's sometimes a misnomer, and I mean, like I said, we don't know what's fully going to happen, but I know that you guys as an audience are probably thinking about it, and it hasn't happened yet. That's all I will tell you, is that if there is going to be that big wall of distress transactions, they haven't materialized yet. But again, we've been in lockdown and hard to go out and see properties and do deals, so it might be early. So I'm going to kind of talk about a little bit with future development, give you a little bit of our own speculation, what we sort of think is going to happen, how we're approaching this, and how we think about markets. The first is I think this is a huge cautionary tale, because there's so many discussions about the new normal, the future of office, the future of this. I'm obviously work from home. You can, in the background, I'm in a walkout. My office is built into my walkout basement. I live in New York, in the suburbs, and I will fully admit to you, I've never been happier to live in the suburbs. I have not gotten aboard my Metro North train to head into Manhattan. My office is in the Empire State Building on 32nd floor. I haven't seen that office or a Metro North train since early March. To be honest, I've got a good setup, but I was set up for this before. I did consulting for this. So I have an above average setup. I will tell you that for the rest of our company, a lot of people, this is not the case. I'm very, very personally leery about this whole idea that we'll never go back to the office. And I know Newview, when I was talking to Lisa before, they stayed in. I mean, obviously financial services has been an essential service, so that, they're in a little bit of a different place. But I think people want to be in the office. I mean, I'm not saying we won't, whether we, this whole 6-foot distancing thing. I mean, I think we take precautions, and obviously wearing a mask. I've traveled to Asia a couple times in the last several years, into Tokyo, into Hong Kong, and those cities are way denser than New York. People wear masks. It's a standard. There's actually a mask culture that even gets into fashion. They do it because of pandemics. They dealt with SARS and they dealt with swine flu. So I bring this up to say that there's a lot of mitigation sense that I think can happen, that, I just take very carefully about thinking that something has changed here and now the whole world is going to change. I have some examples here, and I'm sure a lot of you on the call can relate. You know, the internet boom thought we was going to, you know, when we had the original sense of Zoom or this whole setup that we are kind of experiencing, you know, this is not new. But of course, it's a lot better than it was. People thought that might reduce travel conferences. Well, guess what happened? Travel actually expanded. I think because we could see each other, it was easier to go places. That created more motivation. 9/11 happened. People thought, especially in New York, wow, high rises, no more. People are going to move to New Jersey, no more buildings above five stories. Well, that reversed itself. Frankly, that also even was going to reduce travel as well. Well, travel hit all-time record highs literally about less than 2 years afterwards. And obviously one that I think some of you might be more, especially if you're in Florida for sure, or a lot of the Southeast cities or really anywhere, you know, home ownership was supposed, I mean, if I remember the articles or in the Atlantic and in New York Times about how this generation of millennials would never buy houses. They watched their parents get hit in this, you know, foreclosure boom, and home ownership rates were going to fall down to like 50% from a high of near 70. And these, you know, home prices were never going to rebound for like 40 years. I mean, these were all these headlines. Yeah, they were all false, or they all did not pan out. I can't, you know, they weren't, maybe, you know, false is maybe the wrong phrase. Home ownership rebounded, record, the new home price, is, you know, the average median new home price in the US, I think hit an all-time record high, definitely by 2013 and maybe earlier, I don't remember just offhand. People want to live in houses. In fact, the average size of a new house increased. So I say all this to know that these new normal discussions need bounded rationality to them. My advice and what we're largely approaching in our company and the way we are, you know, we're doing a lot of research, future design, what's going to come next, what's going to happen. We are trying to understand this as best we can. We are trying to connect it to the trends and the desires that we saw in place that our tenants and our, you know, our tenants wanted before all this happened. What's going to be accelerated? What might get delayed? For us, as our company, we are big on innovation technology. We are really looking to see what is going to be the most technologically innovative building. What's going to, we were thinking, and we still are looking at what's parking going to be? What if we actually do have better use of rideshare and eventually, you know, like autonomous vehicles? Will that change parking? You know, we recognize that if we can create a leading building, people are going to want to live and work in it. We think culture, this is an interesting thing that at our own company, we value our culture a lot. You know, are we getting more efficient? I mean, this has been a very interesting experiment in this whole work from home environment. We've been very productive, but it's also been very limited. And I will tell you that the ability to cross collaborate, because we've been forced to do it, has been very interesting. And for us, so if we have offices, our main development offices are Boston, DC, Houston, Seattle, and in Los Angeles. We also have a team of corporate people, myself included, in New York. We're mostly travelers anyway, like when there's not really a lot that goes on there. We also have a few people we have people in Portland and also people in Charlotte. And in addition, we have headquarters back in Stockholm and compatriots in other parts of Europe. We've done a lot of cross collaboration. I mean, this has been a very interesting, and it's brought parts of our team that weren't physically located together in very interesting ways. And I feel like our whole approach to how we do business is going to be impacted. I'm not going to say it's going to change substantially, but we're looking to what we can learn from this. But we all want to see each other. And I think that how we work is going to be something very interesting. You know, we want to live in high quality places. We care about quality of life. And I think the biggest question, so I have two big questions. And I purposely, just because I didn't necessarily want to have them printed because I didn't know exactly how I want to say them because my opinions changed, but I have two major questions. And I call them questions because I feel that I don't know enough to call it a prediction yet, but I'll tell you that we're watching them very, very closely. One trend is obviously, which was definitely in place, was sort of a shift of growth and energy kind of down to the south and the southwest. Now, obviously, if you're in Florida, you're in it. You've seen it. You drive around, you see the cranes. It's not a new story. Growth in Florida, and frankly, coming from New York, being in New York now, I was kind of the weird one who went from Florida to New York, or most of it went from New York to Florida. The tax law changes me. So that's one question: is do companies want to, do they find the burden of a New York City or a San Francisco to be too much, and now they think Texas is more interesting than Florida, the Carolinas, Nashville, Arizona, Denver? You can name off all these sort of interesting hotbed cities that are, sort of outside of the primary, gateway city effect. I'm really wondering, is this going to be from like, Jamie Dimon, CEO of JP Morgan Chase was out there. This is like a year ago, or nah, it wasn't even a year ago, like half a year ago, saying, I think I want to move maybe half of these people, like 1,000 people, out of Manhattan into maybe Texas or West Palm Beach, and sell our one tower that's right on Madison that we got from Bear Stearns. It was a little bit. It was honestly Jamie Dimon, I think, trying to sort of throw shade at Mayor Bill de Blasio, which is a popular sport here in New York. But it's a question: does he extend that? Morgan Stanley said the same thing. Now the Citigroup CEOs have said, no, we're all coming back to the office. We're coming back to New York. That's where we want to be. But that's a big question: is will there be more of an outflow to some of these lower cost secondary cities? Some of the original, if those of you are familiar with CoStar, which owns LoopNet and Apartments.com, they have been watching the search flow. A lot of people from high cost areas are searching down in the we call it the lower cost southern and southwest cities. So that's my one big trend that I personally think that was already a trend that was happening. I think as an acceleration due to everything we're seeing is totally plausible. I wouldn't be surprised. The next one, I'm a little bit more on the fence about what will happen, but it's got more early evidence. That is what I call the urban to suburban shift. Now, the last 20 years have been a big, call it urbanization or re-urbanization, where people have been desiring intentionally to be in the big cities, literally in the city, living in the downtown, certainly working there, and kind of leaving the suburbs to do it in some cases. There has been in New York and a lot of other cities a big suburban outflow. I live in New Rochelle. I live in a suburb. I'm pretty confident my home price has gone up in this. I mean, I'm not trying to sell, but I've heard about bidding wars like crazy. Have you heard of increased sales and lower time to market in places like, I still get stats from Orlando often, but I've seen it in cities in Texas. I mean, it's kind of across the board. Home prices are going up. And there's not a lot of extra supply. That's the thing about it. There's not a lot. There's homes in the suburbs are really going to be in short supply. So if you like to buy and own single family homes, the prices are probably universally going to go up if there's any modicum standard of living there. So that's going to be a question. Do people want to? Is there some deurbanization? Obviously, we've also seen issues of civil unrest and things like this, which obviously got a whole bunch of very interesting, very complex matters here. But that's a historical thing that sometimes causes also more suburban outflow. So to me, the suburbs were suddenly like, I want to get in my car. I don't want to be on a train because be it the virus or I just don't want to deal with this. Might be a little bit of a reversal. It could be very short term. I will give my warnings that this could be the case for 2020, but then prices of the homes go up, things change, and people decide, no, I actually do like the urban. So those are kind of my big questions that I think, but I do think there will be some winners there. I do think you'll see some suburbs will benefit, certainly on the housing front. I do think that some of the southern cities those cities that were already doing well, I think will only do better. I think the lower cost of living will become factorial, especially if the economy's weaker, people care about it more. The tax of a high city gets more painful, and we might see that. But the big but is people do want quality of life, and they want to live and work in quality spaces. We've seen this in almost every market. We really don't think that's going to change. So I think no matter what we build, as we look at markets, we know that we will win if we can sort of provide the best quality space. And so we're doing research as what that is. So if you're out there and you're looking at a real estate portfolio, real estate investment, you have to ask yourself, what is the quality and how will it do? And what happens if some developer comes in behind you and builds something else? Will that new developer client, will those tenants want to up and move to there? And those are the kind of factors I think people should look at, because I will tell you that development's not stopping, investment is not stopping. We are going to move onward. So I think I'm coming pretty much to the end of what my prepared remarks are. I'm going to open up the Q&A function, and so if you type in your questions, and I think we can kind of extend the conversation as it goes. So the first question, I see Lisa coming back, is, will this be recorded? And that is definitely a question Lisa will have to, and she is nodding yes. Okay. The next one is from Orlando area. So does your company plan to do multifamily housing and affordable housing in Central Florida? So we're not in Central Florida. I can't tell you if we will or won't be, but we definitely research around. Our construction company team is there, so it's definitely it's on, if we wanted to, we would have the resources, but we've made no decision. We generally have stuck to what we call luxury multifamily. We have not really been in the affordable space. Our company is not generally structured for it very well, or nor is our construction company really such a leader in some of that product. But the market shifts might shift our strategy in our construction company. Listen, we didn't do multifamily at all as a company until about 5 years ago. In the Nordics and in Central Europe and in the UK, where we also developed, it's almost entirely office space. Now, I should caveat that in Europe, we do have an actual home builder division. There's a residential development. They actually have a partnership with IKEA to build, it's called Beauclerc. They build like a modular home. So we have this partnership with IKEA, which who knows if we'd ever, I don't know if it'll ever come to the States, but it's pretty cool. But, for doing multifamily apartments was a huge shift for Skanska, and we did it, and guess what? We started making a lot of money with it. So they said, do more, as you can imagine, as a headquarters telling a unit to do. So I don't know the answer to that, to be honest, directly. Tell me more about industrial warehouse space in South Florida. That's very specific. I used to do a lot of research for that when I did work with the NAOP Foundation before I joined Skanska. Look, industrial is doing pretty well. Everybody who's suddenly bought everything through Amazon, you're going to see some more leasing of this online shopping, which even the last holdouts have probably figured out. So I would suspect that industrial warehouse will generally do. I mean, by the stats from the region, I think it's done exceptionally well in the short term. I don't see why South Florida. I don't really have any specific comment other than I think South Florida will probably be okay. So I don't know why there'd be a problem down there, but I don't really have any data on South Florida in specific. Let's see. Do you think there will be a downturn in the market? Do you see it shifting buyers or sellers? Yeah, so this was Carla who asked this. If you want to say which market, do you mean housing or do you mean commercial or just mean general? But I will, if you add an extra qualifier, I'll go further. But I think prices in commercial real estate, the price of a building, it's a simple formula that generally comes up with your price, and it's there's a thing called a cap rate or some valuation multiplier, which is generally with interest rates. So frankly, interest rates are really low, so that's a thing that actually would pressure prices up otherwise, in general. So but the other side of it is net operating income, or essentially the effective net, the net profits or net rent, however you want to best describe it. So there's predictions around the horn from various data providers about declines in commercial prices in the order of maybe 20%. Almost all those are very driven, or at least by what they think will be lower rents and higher vacancies. So, that's a market move. So to that respect, that will lower prices. I will tell you right now, I've already seen it. I've already seen posts. I've seen emails. There's going to be buyers like crazy going after distressed assets. There always are. Every hedge fund. I mean, everyone wants to buy distressed real estate, and there's some, people think there's going to be a panacea of it. I don't think that comes out, but I think, and it's an interesting time. Do you think building is more profitable than rehabbing? I'm assuming that's probably a question about single family homes. I know I know some of the nature of, a lot of you probably are doing that. I think that's a deal by deal question, honestly. I mean, the cost of building, it's a building for us, and I think for a lot of the developers and the home builders, is a scale factor, right? I mean, we have to have a lot of scale. I mean, we're often tearing down an old, when I say old, I mean like old building in some of these urban markets we're in. The thing about rehabbing that is difficult is that there's a lot more competition. It's just a lot easier. So I just can't necessarily tell you that rehabbing is going to be better, because frankly, when I was in Florida, it got so competitive what people were willing to pay that I don't know how anybody made money doing it, but yet, unless you were literally going to go with your own hammer, but not my space. So I'll say that. Let's see. And I got, let's see, I think, my friend Gary Ralston is on and sent me a chat. As the government subsidies in, let's see. Yeah, I think, this is a big question, because we're going to be facing a thing. This is a phrase I think is called the fiscal cliff. By that, I mean, we have a set of fiscal stimulus that's in place, and it's set to expire July 31st. That is the $600 extra payments. I I think the government renews it, but I don't know for sure, and I don't have a crystal ball to tell you what politics are going to be. I think that I don't know. I mean, I think that it's a really mixed bag, because if we're reopening the country and jobs are coming back, then we don't need it. And it is very true. When people talk about the fact that, well, they're making people are making more money on unemployment, they don't want to come back to work. Yeah, I mean, that is real for some people. There's also people who, if they came back to work, they'd be on reduced schedules. You think about your service workers and your servers who aren't going to get all their tips. You think about the hours, so there's also people that are legitimately behind on their income. And I believe one of the reasons why multifamily rents have been paid at nearly 90+%, nearly about the same as it was last year, and in affordable housing and the workforce housing has been seen well, is because these government subsidies have basically blunted it. If we pull them off and we are not back to much better employment, yes, there will likely be some harm. How deep it is really difficult, because we are recovering. So it's a very, we can't live on those forever. At the same time, I think, I guess if I had a vote, if I was contacting my congressman, I think I'd tell them to renew them for at least a month or two and then maybe reassess. But if we don't do it, I am a little bit concerned. But, we are resurging. Watch that jobs number when in that second, I guess it's the second week of July, when that next jobs number comes out, that'll tell you a big question about where we're going. So very good question. Let me, let's see here. With expected defaults of small business loans and the impact you have on the commercial, the small business space is very, very dicey right now. Obviously the PPP loan program and some of these other emergency loans have definitely been beneficial. We think that's also why they've helped jobs. I don't know it's enough necessarily. It goes back to that depth of this. We don't know the depth of the pandemic per se. So if small businesses go out, especially listen, this is your question, Gilbert, is definitely what's hurting retail real estate, as we speak, because retailers are in big trouble. It could spill over into other things. Ironically, and people find this somewhat odd given it's a pandemic, but the other sector that's been hurt really bad besides retail and lodging has been healthcare. A lot of small businesses there, but a lot of doctors and dentists were literally shut down too, and they're not much better. So I do think that what kind of stimulus we put in for small business, I do think there is some bipartisan support for that. If small businesses stay open, they can pay the rent, but yes, if there's trouble there, it is unequivocally a risk factor. But again, I think the government, oddly enough, I think banks, government, all the people, listen, I'll say this as for commercial real estate, I think this has been true with Skanska, and we don't really have a lot of, it's not something we deal with as much, but most landlords, I know some really big ones in New York here, where I've read their LinkedIn posts and blog posts, they really want to keep the businesses open. So listen, hey, you can't pay rent this month? We get it. When you reopen, start paying rent. We'll just pretend that this didn't happen. So a lot of the commercial real estate people, the value is on the going forward. So if we can keep the tenant, if we can keep them paying rent and keep that business open, the landlords are really incentivized to do it. And if you own property out there that has commercial tenants, I strongly would advise try to keep the business open. It's not going to count on reletting it. That's the problem, right? If you let them close, what comes next? In commercial real estate, do you see that your company might do more mixed-use property, storefront, and multifamily living in the same building? Yeah, we have been doing mixed use. Frankly, a lot of times in the cities that we're in, having retail ground floors, retail villages kind of attached is often required, and it makes sense for the market. We definitely were moving on that path to do more of it. I don't see that changing. It is tough because I can tell you in practice, adding a bunch of retail space at the ground floor of an apartment building, sometimes there's nothing else to do, but it doesn't guarantee that there's a tenant out there. And I think you can drive around a lot of markets in a lot of cities and see a lot of vacant retail at the ground floor buildings. So I think, would I like to do it? Sure. Is it easy to do? Unfortunately, it's just not that easy. Let's see. Are you able to give any advice to a novice real estate group on how to start investing in commercial real estate? Well, I think that's a good question. Obviously you have to be, if you are going to invest, I mean, understand, if you don't understand, this is my general advice on anything. It's my own personal, this is more like, I'll be honest, this is more life advice, but it really applies to this. Be very careful about doing that which you don't understand. Commercial real estate is it's a tricky asset class. The buildings are very specific. So I would tell you that if you truly are a novice, get good advisors, consultants, educate yourself. I mean, just be very careful. I think, single family homes are always, I always thought that was a very easy place for kind of individual investors to go, in part because you understand what a home is. You can go look at a house. You probably lived in a house, maybe you still do now. You can understand what motivates the buyers and sellers. When you get into the commercial real estate market, I mean, it's not so obvious why a space has been vacant all this time or what's happened. And you can, there's more risk there. And you could argue there's more upside because of that. But so my advice would be is don't make any investments that you don't fully understand. I do think a lot of people like to go into apartments for that reason, because they're easier to understand. And if you were managing single family rentals, and managing apartments it doesn't change that much. So my only advice is stick where and if you were used to single family homes, going to small apartments is probably the safest thing to do. But I don't, I definitely can't give you that advice directly, but just don't do anything you don't understand, please. How do you see market for rental of light industrial, a kitchen cabinet maker? That's a very, very specific. And if you know one in Central Florida, light industrial is very loaded with small business. So I will tell you that that's probably going to ebb and flow with the economy. It's definitely at risk in a relative basis. But if we do get to a big rebound, where a lot of people think we will, just, is it 2020 or 2021 or even 22 at the latest? It probably does well in a general economic rebound. And, look, if you're a kitchen cabinet maker and there is a big suburban outflow, everyone wants to buy a house, I would guess you would do well. But, you might have a painful year. So I guess my answer is that those kind of light industrial things that are small business driven could have a very painful 2 years ahead of it. Maybe it looks really good after that. So, plan accordingly. Let's see. What is the best way to get educated on commercial real estate investing? Are there memberships you recommend? I've been involved. I'm actually testing with CCIM. They're a certified commercial investment member. They're a larger, they're a spinoff of the National Association of Realtors. I think CCIM and their, and their instructors, that's always kind of the one place. The universities, I would, that's when I would have students who didn't, like when I was in university, that's where I usually would send them. So, by the way, CCIM and, well, let me see with that question. You don't say where you're located, Grace, asking the question, but I know in Florida in general, and certainly Central Florida, very, very active organizations there. So your local organization like that where you can join and talk to people is probably it's an easy step. But that's my one organization. So, and Grace is in Orlando. Yeah, the CCIM chapter in Orlando is very strong. I'm sure their website's active, and you can, I would start there for sure. A lot of good professionals in that group. Let's see. And let me see if I have, I think that might be it. So, well, can you repeat the name? Oh yeah, I'll repeat it. CCIM, which stands for Certified Commercial Investment Member. That is a designation they give, but I think CCIM Institute is the national organization, and they do have an Orlando chapter. So it's a trade organization. It's not I don't know what you call it. It's a trade organization is the best way to describe it. And I would, if you're in Orlando, yeah, actually Gary Ralston, who's on here, is a CCIM instructor, a good friend of mine, ccim.com. You can go there, and I'm pretty sure you can find it, to find information. Do you recommend industrial parks in this climate? Yeah, I think I've covered industrial. I think industrial will largely do pretty well. I mean, obviously anything that touches e-commerce will do well. The only thing I say is that if we had if a recession goes on for a long period of time, small business, which is often what's in a lot of industrial parks, will get impacted. So there's risk to it is the honest answer, but probably lifetime of it, I'm sure those businesses will hopefully do fairly well. So I know we're getting close on time as well, Grace. So, and Lisa, you guys, do you want to take back over? And Lisa will take back over. Thank you so much.